Hey, and welcome back to the channel. I'm your host, Ian, and today we're diving into the 1990s real estate bust. This period saw a sharp recession, soaring interest rates, and a dramatic 27% plunge in Toronto home prices. First, let's set the stage with a broader economic context here. The early 1990s recession lasted from about 1990 to 1992, though its effects lingered longer in some sectors like housing. This wasn't just a mild slowdown, it was one of the deepest recessions since the Great Depression for Canada. GDP growth slowed to a crawl. It was 2.3% in 1989, then barely 0.2% in 1990, then went back up to 2.1% in 1991 before starting to rebound, going back to 0.9% in 1992, and then back up to 2.7% in 1993. So what caused all this? Well, it was a mix of factors. The Bank of Canada had been aggressively hiking interest rates in the late 1980s to fight inflation, which had been creeping up due to speculative booms in assets like real estate. By the 1990s, the bank key rate hit around 14%, and prime lending rates averaged over 13% that year, with mortgage rates often exceeding 12 to 13%. This made borrowing expensive, choking off consumer spending and business investment. On top of that, the federal government introduced the Goods and Services Tax, GST, in 1991, which added to inflationary pressures and dented consumer confidence. There was also spillover from the US, where the recession ran from July 1990 to March 1991, hurting Canadian exports since the US was our biggest trading partner. Now, let's not forget the global context here. Oil price shocks from the Gulf War in 1990 to 1991 added fuel to the fire. Nationwide, the recession hammered employment. Unemployment surged from about 7.5% in 1989 to a peak of almost 12% in 1993, staying elevated around 10 to 11% through much of the early 1990s. Provinces like Ontario and Quebec were really hit the hardest, with manufacturing jobs vanishing as factories closed or downsized. In Atlantic Canada and the prairies, resource sectors really struggled too. This job loss created a vicious cycle. People couldn't afford mortgages, leading to foreclosures, which flooded the market with cheap properties and drove prices down even further. Real estate wasn't just affected, it amplified the downturn because housing is such a big part of household wealth and economic activity here in Canada. Now, taking a moment to zoom into Toronto, where the bust was most dramatic, the 1980s had been a wild boom time for Toronto real estate. Average home prices nearly doubled, fueled by low interest rates earlier in the decade, easy credit, immigration surges, and speculative buying. But when the recession hit, it all unraveled. From 1989 to 1996, nominal prices in Toronto dropped about 27%, with some estimates putting the real, the inflation-adjusted decline at 38% in the Greater Toronto Area. Sales volumes plummeted too, from over 49,000 in 1989 to around 25,000 in 1996. Though exact figures vary. Condos got slammed especially hard. Overbuilding in the 80s led to a glut, and prices for new units plunged. Many owners ended up in negative equity, owing more on their mortgages than their homes were even worth, which locked them in place and stifled the market. So why was Toronto specifically hit so hard in this? Well, high unemployment was a big factor. Ontario's rate climbed to over 10% by 1992, with Toronto's manufacturing and finance sectors shedding jobs. Interest rates were crushing, 5-year fixed mortgages averaging around 11 to 12% in the early 90s, making payments unaffordable for many. Then there was the Quebec sovereignty risk, and the 1995 referendum of Quebec independence was really a nail biter that a lot were keeping focus on, with the no side winning by just 50.6% to 49.4%. Leading up to it, fears of political instability caused businesses to relocate from Montreal to Toronto or elsewhere. It also created national uncertainty. Stock markets wobbled and the Canadian dollar dropped sharply, and investors' confidence really tanked. In real estate, this translated to hesitation. Buyers in Toronto and beyond held off, worried about economic fallout if Quebec did separate. Reports from the time show business relocations spiked and Montreal's market stalled as people delayed purchases amid the sovereignty talk. US spillover added pressure too, as weaker American demand hurt Ontario's export-driven economy. Overall, and nationally, the bust wasn't uniform. Vancouver saw a dip but recovered faster due to Asian investment inflows. Calgary and Edmonton, tied to oil, had volatility but less severe housing plunges. Overall, Canadian home prices dropped around 20% in real terms from 1990 to 1996, with the recession wiping out billions in wealth. Commercial real estate crashed too, with office vacancies soaring due to overbuilding in the 80s and the economic slowdown. So what did people think about real estate during this roller coaster? Pre-bust in the 80s, it was excitement, mixed with growing unease. The boom started innocently enough with falling interest rates after the early 80s recession. Prime rates dropped from over 20% in the 80s to around 9 to 10% by the mid-decade. Credit expanded, immigration boomed, and deficit spending really fueled the economy. People saw real estate as a can't-lose investment. Classic. Speculation was rampant, with people flipping properties and assuming prices would just keep rising forever. Newspaper articles from the late 80s warned of a bubble, with headlines about overheated markets and affordability crises. Some economists predicted a correction, but many dismissed it, thinking Toronto's growth would sustain appreciation. During the bust, though, sentiment, as it usually does, completely flipped to fear and despair. By 1990 to 91, as prices tanked and unemployment rose, people viewed real estate as a trap. Negative equity was widespread. Homeowners couldn't sell without losses, leading to jingle mail, where keys were mailed back to banks. People didn't think there would be this endless appreciation anymore. There was a question if they would even ever get their money back out of the property, and if real estate was a safe asset in the end. Post-bust by 1996 to 97, sentiment was cautious, but turning optimistic again. Prices stabilized in Toronto by 96, then flatlined for about 5 years before starting to really go back up. Recovery kicked back in the late 90s, driven by falling interest rates. Bank of Canada cut to around 3 to 4% by 1998. Strong job growth, a booming stock market, and a rising US dollar boosting exports. Nationwide, GDP growth averaged over 4% from 97 to 2000. People started seeing real estate as a viable investment again, but with some lessons learned. No more blind faith and perpetual gains. Accounts from the time show relief, with some viewing the bust as a lost decade, but an opportunity for buyers entering at lows. Wrapping this up, the 90s bust reminds us how interconnected real estate is with the economy, politics, and global events. The 27% Toronto plunge shattered assumptions and reshaped sentiment from boom time optimism to bust era caution, then measured recovery. If you're watching this in 2025, it's a stark contrast to recent cycle. But hopefully, history like this helps us to navigate today's market. The real question though is, did we really learn from our mistakes and the things that happened? Or are we doomed to repeat ourselves? As again and again, we go through these booms and busts where people are thinking real estate is invincible. It's an ever appreciating asset. And then there's a bust and things crash and everybody thinks real estate is the end of the world. You'll never get your money out of it. Will this happen again? Probably, but we shall see. Let me know your thoughts. That's all for today. I'll see you on the next one.